Here. How do you guys feel? Good? Huh? Yeah, good. Ready to go? Yeah, ready to start it. And down is to advance. Correct. Perfect. All right, we're all set. Good afternoon, judges. My name is Ian Hastings. This is Davis McCall, Alex Boozer, and Dan Pnoyer. We are representing Montana State University in today's presentation on Red Line Hotels Corporation. We are recommending a buy on this company with a one-year target price of $14.85, representing 44% upside potential. We believe this company has been overlooked and undervalued due to its transition to an asset-light franchising model, further increasing margins and profitability, as well as its strong organic growth potential and its proprietary management platform and rewards program. Today, Red Line has over 1,000 properties, both open and under development, and through strengthened brand identity, they are well positioned for sustainable future growth. The company was founded in 1937. In 1998, they IPO'd on the New York Stock Exchange. Since the early 2000s, they've completed multiple acquisitions and sold off their entertainment business, Tickets West. And most recently, in 2016, they acquired Vantage Hospitality and their 9 brands. Today, Red Line is solely focused on operating as a hospitality and leisure company. They're committed to growing their franchising business, as well as selling off their company-operated hotels and increasing profitability across the board. They currently have multiple brands within the economy, mid-scale, and upscale segments of the industry. They have a very seasoned management team that has been further strengthened through the acquisition with Vantage, further increasing their experience, as well as they have multiple members on the team that have proven growth and acquisitional strategy. From here, I'd like to pass it on to Davis to talk about the industry and financial analysis.
Many external factors mold the hospitality and leisure industry. Some of the key influencers we've identified are the growing popularity in home sharing companies such as Airbnb and VRBO, the use of technology through online bookings, the growth in discretionary income in the United States, the growing attention to green policies and preferences, and the potential for travel restrictions and the current weak US dollar. As we look closer at the industry, we see it's very competitive. Current rivals currently are renovating, revamping, and upscaling their hotels. The threat of substitutes is also large. People are growing more comfortable using home sharing companies at consistently low costs. Competitive bargaining power is moderate due to the availability of technology, which is making price comparisons easy and reviews easy online. Supplier bargaining power is low due to the ability to replace labor with technology, and the threat of new entrants is also low due to the capital requirements and the time it takes to recognize your brand in the community. As we look at the group competition map, we see that Red Line has diverse brands across a wide spectrum, from value-priced, efficient hotels all the way to luxury brands that focus on the experience. Some key indicators that differentiate Red Line from the industry are their willingness to be flexible with their franchise agreements. Their proprietary software, RevPAC, which has historically improved revenue per available room, and their new release of Franchise Easy, which targets value customer franchise customers using the Country Hearth brand. Some other features are their franchise incentives they currently have. Some include the low to no interest loans they'll issue to franchisors and the availability of key money. Red Line also offers Hello Rewards, which is an instant gratification reward system, which increases brand loyalty. They also have negotiated contracts with Expedia to help their franchisors leverage online bookings in favor of their hotels. As we move into their financial analysis, we can see that Red Line has its revenues highly concentrated in the United States. They also have exposure in India, Mexico, South Korea, and Canada. Over the last 3 years, Red Line has been increasing its debt. They had a hiccup in their operating margin in 15, but have slowly been recovering in 16. And in 16, they also had a decrease in the ROE attributed to expenses associated with their acquisition of Vantage. Compared to competitors, at first, Red Line may appear that it's struggling. But if we take into consideration they're a company in transition, and they've recently had non-recurring expenses with the acquisition, we can realize that the market has undervalued their future profitability and that there is large potential for high upside. Red Line has recently been selling off their owned and operated hotels in transition to an asset-light franchise model. This will increase their margins, decrease their debt, and overall increase their return on equity. Alex Boozer will now walk us through our valuation.
In order to value Redline stock, we use both absolute and relative measures. We use unlevered discounted cash flow models, and the following macroeconomic assumptions drove our results. They include the risk-free rate, the equity risk premium, beta, a long-term growth rate, and a forward tax rate. We consider our long-term growth rate of 3.5% to be conservative, considering 4.7% expected US GDP growth this year. In total, we generated 6 discounted cash flow models, weighting price outcomes by probability to arrive at a blended price of $14.85. Our target price is a weighted average of 6 different scenarios. Our best estimate scenario is most heavily weighted at 50% and represents our best expectations for Redline's future. We expect the company to sell 14 company-operated hotels total, with 10 coming in this year, 2 in 2019, and 2 in 2020. The company has already reached agreements to sell 5 of these company-operated hotels, and we expect this deal to close by March. We also expect the company to make an acquisition in 2019, and we've set our forward operating margin to 30%. This 30% margin is based on historical data from Redline's franchised hotels. Furthermore, we've set CapEx at 5% of revenue, which we also consider to be conservative, considering Intercontinental Hotel Group's, a comparable company, is at 3.8% of revenue on average. Our best estimate scenario leads us to a price outcome of just over $16, representing nearly 60% upside. In terms of relative valuation, enterprise value to EBITDA is slightly below the industry average. Price to book and price to sales multiples are well below the industry average, indicating an undervalued stock. With that being said, I'll pass it on to Dan Knoyer to discuss risk factors.
Thanks, Alex. The most significant risk to our target price is a lack of suitable acquisition targets or insufficient capital for an acquisition. Redline recently entered an agreement to sell 5 of their company-owned hotels, and management has indicated that the sales price has come in above their expectations. We believe that through liquidating their owned properties and access to debt markets afforded by their increasing balance sheet, their stronger balance sheet position in the future will ensure that they have plenty of access to capital in the future. The company also has indicated that they have a number of regional hotel franchising brands that would make a good acquisition for the company. Rising interest rates would also impact our discount rate and thus impact our target price. However, we believe the value of Redline stock will be priced into the company's stock price within the coming year, and that long-term interest rates should stay relatively constant over this short time horizon. Poor brand performance would significantly impact the revenue growth rates that we have estimated. However, this year, management has revised their expectations for franchise agreements up to 140 new contracts signed. We believe that this indicates that hotel owners are taking kindly to the new brands and the stronger brand positioning of Redline. We expect this to continue in the future. Thinning margins would also impact our target price. However, the franchise business has proven its capability to operate at a 30% operating margin in the third quarter of 2017, and also displayed strong margin expansion over the first 3 quarters of 2017. Travel restrictions and a strengthening US dollar would also potentially impact our stock price. However, we believe that these are not very probable and would not be very impactful on our eventual target price and our recommendation. We modeled the impact of all of these risk factors in various discounted cash flow models. In each model, we changed key assumptions, including revenue growth rates, margin expansion, timing of acquisitions, and their capital expenditures. And in 5 of 6 of these scenarios, we maintained a buy rating on our stock, indicating that we have a very wide margin of safety and a large degree of confidence in our recommendation. In summary, Redline has seen a negative stock price impact due to its poor financial performance in the past and its current balance sheet position. However, we believe that this stock price is not reflective of the company's future profitability and earnings potential. We assign a buy recommendation to this company at a target price of $14.85, representing a 44% upside potential. From there, we'll turn it over to questions.
Great, thank you. So the 14 hotels are to be sold and 5 have been completed, is that right?
They've reached agreements to sell 5.
To sell 5, okay.
The sales have not yet closed.
Okay, so any thoughts on proceeds for those 5 and for the additional 9, and also the use of that capital as a result?
Yeah, so they got more revenue from selling these hotels than they had expected. And I know one of their big goals with the money they generated from the sales is to pay off debt. I believe it's about $73.5 million in debt. And they're also going to put that towards finding new franchise agreements so they can widen their margins moving forward.
They currently have 11 hotels listed for sale. They expect those 11 hotels to bring in somewhere between $165 to $175 million. We don't have the information on those next 3 hotels.
Okay, and so those proceeds are for a combination of, you said, debt reduction and also expanding the franchise?
Yes.
Yes.
Great, go ahead, Greg.
Okay, you guys are bordering on clairvoyant here. Now, how do you know that there's going to be an acquisition in 2019 and they're going to sell 2 hotels in 2020?
Well, management expected to sell the current 11 listed hotels all in this year. So we decided we would take a little bit more of a conservative approach. And we know that they're going to sell 14 total, although there's only 11 listed now. So in order to just take a little bit more conservative approach, we spread that out through 2020. And based on what they've done so far and reached agreements for 5, we think that, maybe we could have even been a little bit too conservative in that. And in terms of the acquisition, obviously there's no way to know for sure, but as Dan mentioned, they're finding targets now, and with the money they're going to generate from selling these hotels and paying off their debt and their ability and their access to capital, we think it's a very good option.
Good. Your valuation analysis suggests that it's undervalued because of 2 of the metrics: price to sales, price to book, if I heard right.
Right.
Make a case for why they should be traded at a higher price to sales, not just because the others do. Their business might look different than a Hilton or
Right.
Marriott. So explain why they should trade at these metrics that the industry averages trades at.
Well, moving forward, we expect these margins or these multiples to increase as the stock price goes up. We've got a lot of confidence in our absolute valuation and our discounted cash flow models. So we expect the stock price appreciation to drive that.
We believe that low multiple is just reflective of the company's current past performance, and that this asset-light transition has been relatively overlooked. And that as they transition to asset-light, that will assign the company a higher multiple through stock price appreciation.
Hey, you guys, good presentation. You've done a really nice job.
Thank you.
I actually noticed in terms of their most recent Q3 report, because they haven't reported Q4 yet, that their company-owned hotels division did 18.6% operating margins versus their franchise business only did 15.6%. Why would they be selling the higher operating margin business and reallocating those resources to the lower operating margin entity?
When we were doing our analysis, we actually didn't end up with a 15%, I believe is what you said, on the franchise business. When we were looking through their financial statements, we arrived at a 30% operating margin, so I'm not entirely sure.
I was looking at Q3, you may be looking over the last 6 or 8 quarters or something on those.
We were getting, I believe, 22 in Q1 and then 28 in Q2 and then
30%.
up to 30 in Q3, averaging about between 26 and 28.
We believe that seems reasonable. The competitor companies that we looked at, particularly Intercontinental Hotels Group, they're almost entirely franchise business have achieved a 45% operating margin in that business. So we thought 30% was very reasonable, both based on that third quarter results and from peer companies.
Okay, and I just have one follow-up. So I also noticed you guys used a 21% tax rate assumption, and I know that that's the stated federal rate going forward, but I believe they have NOLs on the balance sheet. So are you guys using a 21% tax rate because you want to do it on a pro forma basis, not on GAAP? And so how should we think about those NOLs on the balance sheet and the tax liability?
Yeah, we did 21%, on a pro forma basis. We didn't, obviously we don't know exactly what to expect moving forward. So we thought that would be, a safer way to be consistent with our tax rate moving forward.
There's a lot of uncertainty just within this new transition, and I think as they find their stride, a lot of this stuff will become a lot clearer. So we figured that was our step for the time being.
The asset light program, which it seems as though many other operators are transitioning to, Is it becoming not quite as lucrative based on increased amount of competition? You know, if I got Marriott and others doing the same program, you know, are the operators, the owners able to negotiate not as lucrative as an agreement with a Red Lion as a result?
Yeah, there's potential that, there are many franchises out in the industry, but Red Lion is targeting people and having wide negotiations with them. So maybe someone who wants to franchise but doesn't want to invest a ton of capital in the Red Lion or into like another company like Marriott, they still want to go in this franchise. Red Lion can come in and help them with the lower brand and walk them all the way through to retain those fees. Or also just keep them in with their Country Hearth brand. Help them franchise, utilize their software, but not quite take on the name. So I think there's still a market for them out there.
Question, you're the first group that mentioned the weak US dollar is maybe being impacting. Can you explain why?
Yeah, so we talked about the weak US dollar, and we think maybe that could have potential to increase travelers from abroad to come into America and spend their dollars here and hopefully increase the amount of customers that Red Lion can have or at their hotels.
And how many franchisees are outside the border?
I think only 5. Yeah, they have very few in Canada, India, Mexico.
Okay. And do you know what the average franchisee is paying Red Lion?
I know they're on a 3-stem basis for like lower fee, like flat fees, percentage of room revenue rented out.
At what's the average rate?
I believe it's around 20 on that first fee that they collect, but with the recent special, they've been 20,000 is that first initial fee that they're collecting. And since they've been doing this new sort of special right now, they're not offering, or they're not collecting royalty fees on that first 12 months. So that was the latest that we had heard based on Davis's research.
Yeah, their limited offer for the first 20 this year, expanding the 20,000 fees, and then they forego the first 12 months of royalty fees if you sign up for 5 years or more.
In terms of the average franchise contract, I'm not sure I have a number off the top of my head.
How about management ownership? Any insider purchases or, you know, CEO, CFO, how much do they own?
We didn't see anything very concerning with management. Nothing that would be of any alarm. I think that CEO is the top, as far as insiders go, has the top holdings right now. But that wasn't any major concern to us. We didn't spend too much time looking into that.
Do you guys think that there's a risk under this new franchise model, since they're kind of guaranteed flat fee, that if we were to go into an economic slowdown, that those franchisees would get, basically squeezed and have to look for alternatives? Or kind of how should we get our hands around the new business model risk versus the old model?
Well, one of the great things that Red Lion is willing to do that other franchisors aren't is to negotiate with their franchisors to move up and down their brands across their franchise or across their fee structure. So maybe a company is not doing well and they're in a luxury brand and the economy turns down. They will help them walk down their brand, but also maintain them to keep bringing fees.
It also does add some degree of safety to Red Lion's top line, because a lot of these are flat fee agreements. So they have some degree of revenue or cycle neutral revenue. So to the point that franchisers aren't actually leaving the system, they do have some downside protection.
Do you guys know if they have any history of doing deferrals for their franchise partners when they are having problems?
I believe they do have a history of setting back some payments and negotiating with them to maintain those customers.
Do you know what the debt maturity schedule is on the company out of interest? It's not a big deal because I know they're going to create a fair amount of cash from the asset sale, but I'm just curious.
They do have somewhere around $20 million coming due within the next year. Obviously, that's going to be the stuff to get off first with the sale of their hotels. In terms of those longer term bonds,
Just 2 of them, right?
yeah, just 2 bonds.
Yeah.
$20 million coming mature this year.
It's about time. Yeah. So perfect. Great. Thank you guys very
Nice
much.
job.
Thanks,
Thanks, nice job.
Thank you.